and I always liked accounting. And for any of you interested in business, you basically can't get enough accounting. What you really need to know is you need to know how the figures are put together, the underlying principles of it, and then you have to know what can be done with those. And
Hi guys and welcome to MentorBase YouTube channel. My name is Alan Arvindan and we are today going to be discussing about the three financial statements and the logic behind it. So in this video what we're going to be doing is we're going to be discussing about the principles behind these financial statements which make it very easy to understand the linkages between these three financial statements. Then we specifically take some examples to understand the linkages between the three financial statements, and finally I give you a list of questions which frequently turn up into investment interview questions. Or so let's first start by discussing and trying to dividing this discussion into today, then we talk about future, and then we talk about overtime. And why I take these three terms is what you'll understand in some time, right? So first, let's understand when we are saying today, there are certain expenses which are primarily you do only for today, right? Or a specific period. Let's say a given year. So let's say you do marketing for a specific year, right? Obviously, you do not do marketing for 3 years altogether in one year, right? Similarly, if you talk about salary, you give salary to employees for a specific period, but not necessarily that you give salary for 3 years, right? And the same principle would also apply with tax and interest, right? Now, the same principle would also apply with, let's say, tax, internet, or the travel expenditure that you might incur in a given period, which is done for a specific year, right? If you're talking about yearly financial statements, right? Now, let's try to talk about future, right? So, the kind of expenses that you might do in advance, for example, advance rent, you might give security deposit to your landlord, which might be over time. The benefit would actually be given in the future time, right? Similarly, advance salary, right? You might give some advance bonuses or loan to your employees, which are basically intended to benefit in the longer run. And similarly, advance tax that you might actually pay in advance to what income you have actually generated, right? And similarly, the kind of expenses that you might also incur in credit, or maybe the benefits that you incur in credit. For example, somebody might give you an advance for the amount of goods that you're going to supply in the future, right? And finally, let's try to discuss about overtime, right? For example, you might purchase laptops, right, which are intended to be used over, let's say, 3 to 4 years, or a mobile phone which you might use it for, let's say, 2 to 3 years, or a car or a two-wheeler which you might use it for 10 years, right? And specifically, if you talk about business, then machines which are intended to be used for even longer periods than 10 years, right? So now let's try to take an example in the second series in trying to understand these principles in the linkages of the three financial statements. So if we talk about, let's say, income statement specifically, so let's say you sell some goods and you generated $1,000, right? Now the benefit would obviously turn up into cash and that would get credited into your cash. Now the assumption here is that you are getting the goods, you are selling the goods and you're receiving the cash at the same time. So your bank account gets credited with $1,000, right? Now let's say at the same time, if there are no other expenses, then you're making a profit of 1,000 directly, which finally belongs to you. You basically, when I mean in terms of financial statements, would mean as a shareholder. So you as a shareholder, you are able to generate $1,000. So in the balance sheet, now in the asset side, you've got $1,000 in cash in the asset side, and $1,000 you've got in retained earnings, which is a part of equity or the liability side, right? Now let's try to complicate things further, right? Now this retained earnings, that $1,000 that you've actually generated in net profit, now flows into the cash flow statement, because in cash flow statement you start with net income. So your net income itself has started by 1,000. So now let's say that you're actually not selling your goods in cash and you're actually selling it in credit, right? So if in case you're selling it on credit, your revenue is still recognized in your income statement because of the principle stating that the revenue is not recognized when the cash is received, but when the risk is transferred. So if I have sold a mobile phone, even if the cash is due to be received after one year, my purchase point my selling point is the point at which I have transferred the mobile phone to the customer, not when I've actually received the cash. So if that is the case, then how will it affect the financial statement? So first is, in your balance sheet, in your liability side, you will record a credit of $1,000. This is exactly opposite to what we did previously, in which we recognize cash as $1,000. So in this case, now your accounts receivable, so in this case, $1,000 would get credited into your account in the accounts receivable side, which is again an asset, right? The asset, because somebody is due to pay you in the future, right? Now let's further see the effect. Now, in terms of the income statement, still there is no expenses, so the profit is still $1,000, and that profit belongs to the shareholders in the form of $1,000, right? So in the balance sheet now, in the liability side, the retained earnings appears to be $1,000, and on the asset side, there's no cash, but there's accounts receivables of $1,000. And the same effect now when this goes into your cash flow statement, although your net income is $1,000, but since your receivables increased by 1,000, because remaining the $1,000 you actually not received in cash, you actually received in credit. So that means if the cash is not received, so your receivables has increased by 1,000, that means negative of $1,000. So in net, you've actually not made any operating cash flows, right? Now let's take another example of expense. So if expense is today and it is done in cash, the effect is very similar. You generate a revenue of 1,000, right? And your balance sheet, though all the existing assumptions remain same, but now since you've done the expense of $200, now your cash reduces by $200, your profit reduces by $200, so does your retained earnings, right? And in the cash flow statement, since your profit itself has reduced by $200, automatically your net income also becomes $800, right? So expense is pretty similar to what we did in case of income. But what if expense is done in credit, right? So in that case, again, even if the expense is done in credit, doesn't mean, just because it is not done in cash, doesn't mean that you will not recognize in the income statement, because the expense is recognized when the expense is done, right? So now if the raw material purchase for $200, your profit drops to 800, your cash remains same because you did not pay in cash. But what is the other account that can get created is that your creditors, so you in your liability side, you get a creditor account of $200 plus, right? So your retained earning was, remember, $800. Now your creditors is $200. So the balance sheet tallies as 1,000 on the asset side and 1,000 on the liability side. But what happens in the cash flow statement? In the cash flow statement, now you've got an increase in creditors, right? Because see, increase in creditors is positive, is a cash inflow. The reason being because you're not spending money on it. In case of receivables, you're not receiving the cash, and hence that's the reason why your receivables was going minus 200, right? But in this case, since it's creditors, you're paying the creditors in a future date, so it's not affecting your cash flow. Hence, your creditors remains same as plus 200. Right? Now let's talk about expenses which are done to benefit the business or anyone, any specific person over time. Right? For example, we talk about machines. So let's say if a company is buying a machine worth $10,000. So now $10,000 is obviously going to benefit across, let's say, 20 years, right? So it's a machine that's going to be used for 20 years. So let's say we divide the entire cost, right? Like in case of creditors, since you're using it for a specific year, you put it in the income statement directly. But now the machine, you're not going to use it for one specific year, you're going to use it for 20 years. So let's just divide that across 20 years. Now, if you divide that across 20 years, then the cost that comes for specific years becomes $500. So first is from the balance sheet. So remember the difference, that the $10,000 machine that you purchased did not enter the income statement, because income statement is only for expenses and income done for specific years. But since you're buying machines which are going to benefit across years, you directly put it in the balance sheet, right? And from the balance sheet, now you are allocating the cost per year cost into the income statement. So your depreciation goes up by $500, which reduces your profit to 300. Now the same depreciation reduces the value of the asset in the balance sheet by about $500. So it makes it 9,500. And similarly, that same depreciation, since it's a non-cash expense, you're actually not paying for the depreciation. You add that back as $500 in the cash flow statement, right? Now, you might ask the question that how did you purchase the machine? So there can be various ways. You can either purchase the machine using, let's say, cash, or you can also fund it, right? So in this case, we have obviously assume that we are taking a loan. So the loan increases by $10,000 in the liability side. At the same time, the asset, goes up by $10,000. Now, since the loan has come up as 10,000 in the cash flow statement, the cash component will increase because of 10,000. And since you purchased the machine with $10,000, since the machine was costing at $10,000 and the loan was for $10,000, both cancel out, making the effect zero. If it was cash, since we don't have that cash, but let's say if there was some cash in the cash flow statement, the effect would be very similar, only that asset would go up by $10,000 and the cash, which itself is an asset, would come down by $10,000, nullifying the entire effect, right? So let's summarize these three effects, right? So in terms of income statement, balance sheet, and cash flow, the best way of looking at the linkages between three financial statements is to just categorize benefits today, benefits later, expense today, expense later, depreciation for expenses or assets which you're purchasing, which are going to be used for many years, and net profit, right? So if benefits later, which means basically revenue later, it is basically creating an asset account in receivables, and that is a negative effect on cash flow statement. Similarly, if you're talking about benefits today, then basically your cash is increasing and so is your net income. So expense later, you would get classified as payables, right? Of any kind of payable. It could be creditors, it could be salary payable, it could be interest payable, it could be tax payable, any kind of payable accounts. So that gets created as a liability account, but it has a positive effect on your cash flow statement because you're not paying, right? And finally, any long-term uses of assets like fixed assets, it directly goes to the balance sheet. It can be an intangible asset also. Let's say if you're buying a patent or if you're buying an intangible software to be used, right? So that directly goes to the balance sheet and then it gets divided, the expense gets divided across years, showing the effect in income statement, getting added back into the cash flow statement because it's a non-cash expense, right? And net profit directly is linked to your retained earnings, right? Now coming to the fact that what are the common interview questions which can come related to this concept. So if you understand this very well, then you can explain questions like walk me through the three financial statements, right? So this is where your answer should start with that the three financial statements, what are the uses? So income statement is an expenses statement is basically talking about the benefits and expenses for a given year. When we're talking about balance sheet, then it is giving a position of the company's assets and liabilities at a point in time. And similarly, the cash flow statement is doing nothing but reconciling how much cash you're generating in different operations, right? Similarly, the second questions is a very now since you understand the benefit and the expenses today or at the later date, you can easily talk about the major line items. How do the three financial statement links? I think we have done a very comprehensive analysis of that. If you had one statement to look at only, which one would that be? The answer should always be cash flow statement because cash is king, and in terms of valuation, cash flow statement is what affects the valuation of a company the most, right? And finally, if depreciation goes up by $10, how will it affect the three financial statement? So you should understand that depreciation is a non-cash expense, so it gets added in the cash flow statement. If you're talking about income statement, then the depreciation would reduce the net income, and if the depreciation goes up by $10, then it would reduce the assets by $10. So I hope you enjoyed this video. I hope this video clarifies on the three linkages of the financial statements, and we'll come up with another video. So if you like this video, please do subscribe to our channel, and I will see you again in another video next week. Bye bye.